I want you to picture two neighbors. Same street. Same subdivision. Houses bought the same year for nearly the same price. The first neighbor earns $78,000 a year. They have a 30-year mortgage. They make the minimum payment every month like clockwork. Sometimes a little late. They've refinanced twice both times to lower the monthly payment. They've been in that house for 11 years and owe almost exactly what they borrowed. When someone mentions the word equity, they change the subject. The second neighbor earns $71,000 a year. They also had a 30-year mortgage. Had, past tense. They paid it off in 14 years. On a salary most financial advisors would call modest. No inheritance, no windfall, no secret income stream. They just understood something about how mortgages work that most people are never taught. That house is now theirs, completely. No payment, no bank, no deadline. Every dollar they used to send to a lender now goes directly into their own life. Tame neighborhood. Similar income. Completely different financial reality. This isn't a story about salary. It's a story about how mortgages are quietly designed to extract maximum interest from people who don't understand the math and what happens when you finally do. Today, I'm going to walk you through the exact strategies that let normal income households eliminate a 30-year mortgage in 14, 15, even 12 years. No gimmicks, no risk. Just math that the bank already knows and is hoping you never figure out. Let me start with one concept that changes everything once you actually see it. Your mortgage is front-loaded. Brutally. Almost dishonestly front-loaded. Most people know they pay interest on a mortgage. What most people don't understand is when they pay it. In the early years of a 30-year mortgage, nearly every dollar of your monthly payment goes to interest. Not principal, interest. Meaning, the bank. Pull out a standard $300,000 mortgage at 7% interest. Your monthly payment is around $1,996. In month one, $1,750 of that goes to interest. Only $246 reduces what you actually owe. Read that again. $1,750 to the bank. $246 toward ownership. In month one. By year 5, you've made 60 payments totaling nearly $120,000. You still owe $279,000. You've barely moved. This is called an amortization schedule. Banks don't hide it, they'll give it to you if you ask. But they don't advertise it either, because once you see it, you can see exactly where to hit them. And that brings us to the first strategy that actually works. Strategy 1. Attack the principal with surgical precision in the early years. Here's what the amortization schedule reveals. Every extra dollar you pay toward principal in the first 10 years of a mortgage eliminates multiple dollars of future interest. That $246 of principal in month 1? If you pay an extra $246 this month, double the principal. You skip an entire future payment. You've effectively bought back 1 month of your future from the bank for $246. In the early years, you can eliminate future months of payments for a few $100s each. By year 20, that same technique costs you $1,500 per skipped payment. The math works heavily in your favor early, heavily against you if you wait. This is why the people who pay off mortgages early almost always start attacking principal in the first 3 years. Not when income rises, not when it feels manageable. From the beginning, when it's cheapest. A household that pays an extra $300 per month toward principal starting in month 1 of a $300,000 mortgage at 7% pays off 8 years early. They save over $115,000 in interest. Total, not $115,000 over time. $115,000 that never leaves their account. $300 a month. The cost of a gym membership, 2 streaming services, and a weekly lunch out. That's the trade being offered. Strategy 2. Make 1 extra payment per year. Period. This is the one people dismiss because it sounds too simple. It isn't simple. It's elegant. Most people are paid bi-weekly 26 times a year. Their mortgage is due monthly 12 times a year. If you pay half your monthly mortgage payment every time you get paid, You make 26 half payments per year. That equals 13 full payments. You've made one full extra payment, not by earning more, not by sacrificing anything obvious, simply by aligning payment timing with your actual pay schedule. On a $300,000 mortgage at 7%, this one structural change alone pays off your mortgage 4 to 5 years early and eliminates more than $60,000 in interest. I want to be very clear about what just happened there. You paid no more per paycheck than you would have otherwise. You just paid on a different schedule. And that different schedule erased 4 to 5 years of payments from your life. The bank already knows this math. They're not going to put it in your welcome packet. Strategy 3. Never treat a refinance as a monthly payment problem. Here's a mistake that destroys mortgage payoff timelines more than almost any other single decision. Rates drop. People refinance. The new payment is $200 lower per month. This feels like winning. They pocket the $200 and move on. What actually happened? They reset their amortization clock. They extended their payoff by years. They moved themselves back to the part of the schedule where nearly every payment goes to interest. A refinance can be a powerful weapon if and only if you use the interest savings to attack principal, not to fund lifestyle. The household that refinances from 7% to 5.5% and keeps paying the same original payment amount, applying the difference entirely to principal, can pay off their mortgage 6 to 8 years early, without ever increasing their total monthly outlay. That's the refinance most people never take, because the bank offers you relief. The smart borrower takes the savings and turns them into a siege on the principal balance. Strategy 4. Understand what you're actually buying with every extra payment. This is the mental model that separates people who execute these strategies consistently from people who intend to but drift. Every extra payment you make on your mortgage is not a payment. It's a purchase. You are buying back future months of your life from the bank. In year 1, each extra month you buy costs around $200 to $300 in additional principal. In year 10, each extra month costs $600 to $900. In year 20, each extra month costs over $1,500. The price goes up every single year you wait. The months at the back of your mortgage are the expensive ones. The months at the front are the cheap ones. You have a limited window to buy them back at a discount. This framing matters because it transforms the emotional experience of extra payments. You're not depriving yourself. You're not being disciplined. You're shopping. You're buying something with a clear, calculable return. You're purchasing future freedom at a price that will only get higher. Strategy 5. Audit every remodel, renovation, and upgrade decision against payoff timeline impact. Two homeowners have a unique vulnerability. The house itself becomes a permission slip for spending. The kitchen needs updating. The bathroom is dated. The deck could be better. These aren't wrong impulses, but most homeowners never calculate what renovation spending costs them in payoff timeline. Not just in dollars. A $20,000 kitchen renovation financed through a home equity loan or added to a refinance doesn't cost $20,000. At 7% over the remaining life of the mortgage, it costs closer to $38,000 when interest is included, and it pushed the payoff date further. More than that, $20,000 applied to principal instead of renovation at year 5 of that mortgage might eliminate 3 full years of payments and $47,000 in interest. The kitchen you chose over that costs you $47,000 in future freedom. This isn't an argument against ever renovating. It's an argument for knowing the actual cost when you decide. Minimalists who pay off mortgages early do the same calculation for their homes that they do for everything else. They ask, is this worth what it actually costs, including the interest, including the timeline, including the optionality I'm trading away? Sometimes yes. Often, when the real number is visible, no.